a surprise from the European Central Bank, a bigger than expected increase in its key interest rates. It went for 50 basis points or half a percentage point. And many analysts had forecast an increase of half that amount. Now, this is the first hike in 11 years by the ECB and takes its rates out of negative territory. Our senior Europe economist Jessica Hinds from Capital Economics joins us now. Jessica, what was the final straw for the central bank in front-loading the rate hike? And what are some of the ECB's key concerns when deciding on raising rates by 50 BPS?
Thank you. Yes, it was a bit of a shock that they had raised by 50 basis points today rather than 25. But it is consistent with some of the media reports that we'd been receiving earlier in the week, that a 50 basis point rate rise was on the table. That seems to be very much down to the scale of the inflation problem that the Eurozone is facing at the moment. Some countries have double-digit inflation, and there are signs that core inflation, so underlying inflation pressures, are only getting worse, not easing.
Yeah, so Jessica, and it seems like more rate hikes are likely. How much of a hike could we be looking at, and what would the ECB be looking out for in its decision?
Yes, at Capital Economics, we think this is going to be this is the first in a series of rate hikes over the next 18 months or so. We currently have 50 basis points in each of the three remaining meetings for this year, so September, October and December. See, today's 50 basis point rate rise might change the calculations a little bit on that, but it's very clear that the ECB is going to be raising rates quite aggressively. We think they're going to get as high as 2%, which would be a fairly restrictive policy stance from the ECB.
Well, the challenge for the ECB is to tame inflation without squeezing the more heavily indebted countries in the bloc, Italy and Greece. So it's also just agreed to this so-called anti-fragmentation tool to ensure that these countries don't suffer too much. Tell us more about this tool. How could it work and how effective might it be?
We've had a few details already from the ECB on their transmission protection mechanism that they've announced today. We're going to get more details at the press conference that's now underway and afterwards as well. It does seem that it's going to be pretty unrestricted. The ECB has said that purchases would be unrestricted. We're not quite sure what that means, but we'll be looking out for that. And they've also indicated that it will be activated to counter unwarranted, disorderly market dynamics that pose a serious threat to the transmission of monetary policy. There's room for a lot of ambiguity in there in just exactly how the Governing Council interprets that. But I think it's clear that the ECB is stepping up and has accelerated its programme for this anti-fragmentation tool. And that will allow it, if needed, to counter an unwarranted rising peripheral bond yields as interest rates are raised over the next couple of years.
And where do you see the euro heading this year, given today's announcements?
Well, our markets team have had a forecast of parity for some time now. That still looks roughly the right call on the basis of even in light of the bigger than expected rate rise today from the ECB. Fundamentally, interest rate differentials between the ECB and the Fed and the relative outlook for economic growth, with the US faring much better than the Eurozone, which we expect to head into recession around the turn of the year, all point to the euro remaining around parity. Now, of course, if we do see a particular deterioration in the Eurozone economic outlook, perhaps because of problems with Europe's energy security related to Russia, then that would suggest that the euro could go lower than parity, perhaps to 0.95, 0.95 to the dollar. Yeah. So, very much the risk to skew to the downside for the euro at the moment.
Yeah, Jessica, also Mario Draghi has resigned again. How is this going to shake up the economic situation in Italy and Europe? Italy, after all, is Europe's third largest nation in the bloc.
Yeah, that's right. I think this wasn't entirely unexpected. And the fact that we're going to get early elections, it really we were going to be having elections in Italy next year in any case. So this really just sort of brings the elections forward rather than and it probably won't change the overall economic outlook for either Italy or the Eurozone. but in the short term. But I think what it will do when we're talking about this anti-fragmentation tool, it's going to be much, much harder for the ECB to come to an agreement on what counts as a unwarranted market dynamics in an unwarranted increase in Italian bond yield if it's driven by Italian political turmoil, as opposed to a sort of more fundamental threat that would be sort of more consistent with an impairment of the transmission mechanism. So I think it is going to make the ECB Governing Council's life very difficult, and it's going to make it much harder to agree just exactly if and when they do step in to the bond markets.
Well, many thanks for speaking with us there, Jessica Hinds from Capital Economics.